So welcome everyone, and thank you all for joining us on such short notice, likely during your lunch hour. So on the call today, and maybe throw that slide up. On the call today, we've got members of our leadership team, including Joe Martin, Kurt Hofer, and Michael Kahn. Kurt, Michael, and myself are members of the investment team, and Joe's a partner and our Chief Client Experience Officer. He's also a senior financial advisor, and he works directly with our clients. So he's been on the front line answering a lot of our clients' concerns. They don't have any gray hair, actually white hair like me, but collectively we've been doing this for nearly 20 years as an independent company, and many of our clients go back much longer than that. So we've actually opened up this call to the general public. So in addition to our clients and some of our partners at Charles Schwab, there may be listeners that are not clients of Summitry. So for those of you that are not clients, we are a registered investment advisory firm located today, and I think a very sunny Foster City, California, which is in the Bay Area just outside of San Francisco. So our whole purpose, it's to help our clients navigate the challenges and opportunities of life in the Bay Area, which I, for one, I think is one of the very best places in the world to live. So obviously Silicon Valley Bank is right here in our backyard, and its failure has it's rippled through the financial markets, the economy, the Bay Area, and well beyond. So hopefully you've seen our emails of late. We've been very proactive in our communications, but last week, this last week's been extremely dynamic. So we wanted to take this opportunity to hear what is on your minds. So the bulk of this call is going to be open to Q&A session, and Joe will moderate that. Just to level set this conversation, we've been dealing with inflationary pressures. Hopefully many of you were on our quarterly investor call last week, where we talked about the inflationary pressures that were coming out of COVID. It's following the massive liquidity injection by the government to spur economic activity and growth. And to combat this, the Fed's initiated the fastest interest rate increase since the late 80s. And this has resulted in the challenges that we're now facing in both the economy and the banking sector. I think by now everyone's aware of what led to the run on Silicon Valley Bank and how the Fed responded to this. And we've explained it well, hopefully, in our communications. But the high-level overview is that Silicon Valley Bank experienced a run on the bank last week, which led to more broader fears about the integrity of the entire banking system. And the government fortunately stepped in, but unfortunately had to step in to ensure that bank depositors would get their deposits. This caused a domino effect with concerns around other Bay Area financial institutions such as First Republic and Charles Schwab. And so again, this was hit us squarely right here in our local community. So I'm sure there are a ton of questions of what this all means. So we'll just get right into it, and I'll turn it over to Joe, and we'll get started with answering them the best we can.
Thank you very much, Colin. And nice. Thank you. I want to thank everybody for joining us as well. I had to move locations there. I was not plugged in, and now that I am, so I can see you all. So what we thought we'd do is just start out with a couple of questions that we've received from a lot of our clients, and then from there answer questions that come in from all of you who are attending the webinar. So a question that we've gotten from a lot of clients is, what do we think, or what are our thoughts about an ongoing spread of this, or sort of like the contagion effects of what's happening? And so we thought that first we would address that question that we're getting a lot of clients. Michael, you want to start out with that?
Yeah, sure. I think one of the things that people have in mind when they bring this question is it, again, 2008 kind of financial crisis we've seen back then. So there are some similarities. We have concerns about banks. We have a large bank that failed. Bank customers are confused about what's happening with their bank, and bank stocks have declined quite a bit. But I think that's where the similarities end with the financial crisis. There are several important factors that make this crisis unique. The current crisis is a liquidity crisis that started with a single institution and has spread from there to a few other banks, most notably First Republic. In 2008, it was a credit crisis that impacted every single institution in the country and almost every large institution outside the country. In 2008, it took 2 to 3 years from when the initial problem started to emerge until regulators intervened in a meaningful way. This time, it took regulators 3 days to intervene in a meaningful way. The assets at the center of the 2008 crisis were mortgages to weak borrowers. Today, the assets some people concerned about is securities issued or guaranteed by the US government. There's just no better credit in the world than the US government. And then the system is very different. In 2008, banks were speculative entities saddled with bad loans sitting on top of poorly structured funding and thin layers of capital. Today, capital requirements are much higher than in 2008, and the system is overcapitalized. And we don't see the type of funding structures we saw in 2008. So it's hard to predict when the fear will subside, but we think these differences between now and 2008 meaningfully improve our chances for a very different outcome in terms of the damage to the system and the economy.
Thank you, Michael. Maybe I know we had one other question that we were going to start with, but I think because a question came in that I think is tied to what you're sharing, I just want to keep it lined up with that, and maybe Colin, Kurt, you jump into. But the question that came in is, please explain why Silicon Valley Bank's investments in treasury bonds caused such a liquidity crisis and a run on the bank.
I could say there, it's not actually the investments in treasuries caused the liquidity crisis, is the nature of Silicon Valley's clients are the source of the problem. Silicon Valley caters to a lot of firms that are not profitable, startups, and it has been a long-term issue for them where a lot of their customers were burning cash because of the nature of their business, and that has been draining their deposits until at some point it turned into a panic and run on the bank, and that's what we've seen last week.
And maybe I should have started in my introductions with Michael. Michael's been with us for a long time, and he was recognized by the Wall Street Journal as one of the top Wall Street analysts covering the financial sector and the banking sector coming out of the global financial crisis. And so he may hog the spotlight here in terms of his knowledge and understanding of the banking industry. And I just want to provide that context as well.
Well, and thank you, Colin and Michael, but I'm going to stay on this because I think getting this question about the run on Silicon Valley Bank. I think the question maybe a little bit also is intending to ask for maybe a clearer understanding or explanation around them having to sell assets to make to be able to pay their customers the money they were withdrawing, the hold to maturity, the available for sale assets that the bank had in their books. Maybe speak a little bit to that, because I think that's probably more the question.
Yeah, so banks collect deposits from their customers and lend them and make loans against those deposits. Any excess deposits that banks have, they'll invest them in securities. And the type of securities that banks invest vary. Treasuries and government guaranteed securities are the most popular asset classes and the most widespread investments you can find in those securities portfolios. So what happens with those securities, banks can classify them as available for sale securities and or held to maturity. There's a difference in terms of how regulators view the capital, the hit to capital from the change in the value of those securities. There are different rules for the largest banks and the smaller banks, and there's different rules that apply to held to maturity securities versus held for sale securities. And what happened when the rates when the Fed started to raise rates is that all investment securities, all fixed income securities decline in value because rates have been rising, and all the banks in this country reported unrealized losses. Those realized losses do not, regulators understand that dynamic, and the accounting profession there are rules that account for this dynamic, and banks can continue to operate even as they report unrealized losses. The economic reality is that if banks hold those securities to maturity, they will get the principal back. So there won't be a loss recognized if those securities are held to maturity. Silicon Valley Bank could not hold them to maturity because of the bank run. They had to sell them at a loss.
If I could put some numbers to this, if you don't mind my jumping in. If you read the news, there were $42 billion of deposits demanded for withdrawal from customers in a single day last week. If you look at the balance sheet at Silicon Valley as of the end of last year, they had less than $14 billion of ready cash on their balance sheet, which meant that they had to go to their securities portfolio, sell securities to raise the cash to meet that $42 billion of demand for deposit withdrawals. They had a $120 billion securities portfolio, of which 3/4 was in this held to maturity securities pool that Michael was talking about. So they had to obviously put in a major bind. They did not have the cash available to meet the demands.
And then so Wednesday, that was accelerated. That started to materialize. Then they were forced to go out and try and raise capital to cover that. That failed, word got out, and then all of a sudden that inspired really a coordinated bank run of get my money out of Silicon Valley Bank. And so it just cavalcated and accelerated that. And so that's kind of the Silicon Valley Bank impact. And I think there's a question, and Michael alluded this. This is sort of well known as an issue that's been on all of the bank's financial statements out there. And so again, it's not unusual, but what exacerbated again was that demand for depositors getting their money back, their capital back in this kind of herd bank run mentality. And that's why it's a bit idiosyncratic risk, idiosyncratic to Silicon Valley Bank. And I think the other thing that's of note here is obviously depositors are protected by FDIC insurance at levels up to $250,000 because of the nature of Silicon Valley Bank's clients, venture capital companies, startups, and the like. The majority of those assets of their cash deposits were well above that $250,000 protected level, and it was concentrated in fewer large clients. And so again, the fear of my money, my capital is not protected, not safe. And then the concentration of clients, not all, but a large majority of them acting in unison, exacerbated this dynamic.
And I want to try to just add to try to make a few connections here. Colin, you mentioned about how much of the deposits at Silicon Valley Bank were under the insured amount. We do get questions from clients because of assets at Schwab. And there is Schwab Bank and there is Schwab Brokerage, and they are distinct. But Schwab Bank is the mirror image of what Silicon Valley Bank had going on. And what I mean by that is 80% of the bank deposit sweeps or the deposits that Schwab has are covered by the FDIC
The opposite,
insurance.
right?
The opposite,
the
opposite of Silicon Valley Bank. At Schwab, 80% of the bank deposits are under the FDIC insured amount. So very different situation. The other connection I want to, Michael had said, and this kind of goes back to the question too, like how, explain how Silicon Valley investments in treasury bonds. This is that idea that Michael had started out with too, where this isn't a credit problem. This is a liquidity problem. It's not that the credits that Silicon Valley Bank had were bad credits, even if a lot of them were treasury bonds. Still, if they had to sell them because of what interest rates and intermediate prices did, having to sell them, they're good credits. It's just selling them at a certain time before they mature, realizes the losses, that gets out, and then people And then it becomes a liquidity crisis where they're not able to meet demand. The other thing I'll say, I wanted to go back to Schwab a little bit too. Schwab, in terms of liquidity, Schwab has been a pretty major beneficiary of this situation. So one, I mean, Schwab has Walt Bettinger, the CEO of Schwab, did a really great interview. I think it was Friday last week. You could Google it, where he explains a lot of the numbers at Schwab. But he talked about how in the month of February, net new assets to Schwab were $42 billion, and in the month of March, net new assets into Schwab were going at a rate of $2 billion a day. And last Friday, one day alone, $4 billion of net new assets came into Schwab. Also on the, they talk about on the bank side how they've got access to $280 billion of liquidity. So more than enough to meet any kind of demand for deposits that they would get. Plus 80% of those deposits are covered for FDIC. So just, Schwab is incredibly strong in an incredibly strong position. So I thought just in terms of people asking us questions too about how do we think about the security of their cash, Schwab is the custodian that we use primarily. But for those of you who, aren't at Schwab, I mean, you want to check in with your custodian and figure out what their numbers around all of these are. Kurt, I'm going to have you start with this question. Because we can't speak to specific securities that are in client portfolios, but I think there's a way to address this in a general way. Preferred stock, how do we think about preferred stocks in banks? And how should we be looking at, to the extent callers or attendees have positions in preferred stocks in their account?
Sure, I'll give it a try. So banks are big issuers of preferred stock, and they do that because the regulators give them favorable treatment. And so in one of our strategies, we do have preferred stock, and we've got exposure to banks in that preferred stock portfolio. So the question is, how do we think about it? And should we be concerned, or how should we feel about these things? And the answer is this. Firstly, we feel good about the safety and soundness of the banking industry in general, right? We've had Silicon Valley Bank. The Federal Reserve came in, provided its support, which meant that they were going to insure all deposits, even those above $250,000, sending a signal to the industry and to depositors around the country that the Fed has got your back, got the banks back, so that they can continue to fund you. They also came out with something called the Bank Term Funding Program on Sunday, which said that if a bank is having troubles like Silicon Valley Bank had, where they got this big securities portfolio and not enough cash to meet the demand for withdrawals, that they could pledge those securities to the government, and the government would give them cash. And the cash could then be used to meet depositor needs if they demanded a withdrawal. So all of these things are very important to our thinking about preferred stocks in the banks, or whether it's a common stock, because we own common stock in banks as well, and preferred stock, and senior debt in banks. We feel good about the safety and soundness of the system. That said, very fluid environment, right? Things are changing dramatically. And so what it prompts us to do is to take a look at that portfolio that we have of preferred stocks, senior debt, common stock, and assess for ourselves what's the strength of this enterprise. And is this something that if the world changes in an adverse way, would we still feel comfortable being in that? And so the decisions that we make as investors is we look through that portfolio, and we will cull the portfolio of those positions where we don't have total confidence. So my points are, I think the safety and soundness of the industry, we feel good about it. It doesn't necessarily mean that we'll stay invested in all bank-related securities. We'll look at it on a case-by-case basis and make the decisions to sell when we think it's appropriate.
I think with your the response there, you probably did answer this question, but maybe there may be something you'd add. Bank stocks in general, so even of the common nature, anything you'd add or thinking about bank stocks as distinct, the common stocks as distinct from the preferred stocks in general?
I think it's the same analysis, and we're looking at the banks and the ones that we think are strong. And you know, our tendency, we're conservative investors, right? I mean, we like to invest in strong and sound enterprises, whether it's a bank or a tech company or whatever. That's just the way we operate. And so, yeah, but we take a look at everything. We don't take anything for granted. We never assume that the world will stay constant, and we stay vigilant and make the decisions on common stock as well as preferred stock.
Thank you, Colin. Michael, anything to add or that you want to add?
Yeah, I'll just say that we do believe that the strong will get stronger, and the weak will get shaken out, and so I think that's a fair assessment.
No, thank you. We may be able to answer this question. I'll put it out there. Is what happened at Silicon Valley Bank primarily a result of lack of federal oversight, deregulation, and or poor management at Silicon Valley Bank?
Yes, yes, and yes.
Yeah, probably a
Michael,
little.
what do you think?
Probably a little of all of these factors. There was definitely poor signs of poor decision making within the bank. Also poor communication. They did say on the last call that, if I remember correctly, the quote was they're seeing cash burn approaching levels, declining cash burn by customers. I think that was the quote, which signaled to investors in the outside world that maybe the drain on their deposits is the pressure on their deposit is coming to an end, and that obviously wasn't the case. That wasn't true, or they misjudged the situation, which is, I don't know which one is worse. And then the capital raise they did last week wasn't enough. Clearly that was a mistake, but yeah, the regulators. This was this model was unique in the banking space. It should have received the proper attention from the regulators earlier than this week, and they didn't. So there definitely will be some conclusions made and some accountability on that regard for sure.
I'll just add, there's this concept of a systemically important bank, and we're talking about the large getting larger and stronger. Silicon Valley Bank consistently managed their assets to stay just below that line, because above that line enters into a much more regulatory strict regime and oversight, and so a whole different set of regulations for these systemically important banks, the largest banks in the country, in the world. So there is that they did have a different set of rules and regulations, and I think, having said that, this question wasn't exactly asked, but I think what will likely unfold is this notion of, are the regulatory restrictions on those non-systemically important banks, do they need to be addressed and tightened and the like? And so I wouldn't be surprised if that unfolds near term. So I think the impact on bank stocks in general, I do think for the smaller banks, the cost of doing business will be significantly higher. The regulatory scrutiny will be higher, and so again, that more reason to sort of position yourselves at those larger business, larger capitalization, systemically important banks that have already sort of dealt through this, coming out of the global financial crisis back in, almost 20 years, getting close to 20 years ago.
Thank you, guys. So a question came in about First Republic, not about the soundness of the bank, but as, okay, with it being down, what it's down, why not back up the truck was actually the word used, and load up on it. And I think, I'm sure Michael, well, probably all of you have a perspective here. I would say though, this is where it kind of depends on what exposures do you already have, what other banks do you already own, because of the nature of who might be on this call. It's about your investment time horizons, your objectives, your all of those things. And so there is that way of approaching this question too, where it kind of depends. But what maybe
I guess maybe just to clarify, since there are non-clients on this call, we are a little bit tempered in what we're allowed to say, and so just so we're not trying to be evasive. It's just that's.
Well, no, and maybe the way to approach the question is, what kind of things might we look at, or we would tell someone that we'd look at if we were considering it or not considering it generally. Maybe.
So I can start, but we look for competitively advantaged businesses that will maintain their dominance and relevance and their market position over the next 5, 10, 20 years. But you need to get there, and to get there, you need to have a strong balance sheet, and in the case of banks, you need to have confidence in your capital structure and the stickiness of your deposits. I have the Bloomberg screen right now open, and the headline is First Republic set to get 30 billion of deposits in rescue. Whenever the situation requires a rescue, there is a concern about the specific entity right now in terms of whether it can get to that 5, 10, 20-year future. So that's a key question for investors to answer. We don't have an answer. What's happening right now is what we read, like everybody else, is that all of the large banks are involved in putting together some sort of a package to rescue First Republic. What will be the nature of that rescue? Nobody knows. What will be the impact to equity holders? We don't know. We can't tell. Nobody can. So until those questions are answered, what we can say is that depositors of First Republic can sleep well at night. They'll be made whole, but only them. We can say it only about the depositors. Until all those questions about what this rescue will look like are answered, there's just a lot of uncertainty around First Republic right now.
This sort of harkens back to me when you go all the way back to 2008, early 2008, when Bear Stearns was sinking and a buyer came in, and that was JP Morgan, and they paid virtually nothing for the asset. And so in Bear Stearns is a business that has existed for years and years and had a reputation, and the same may be true here, that if someone comes in to rescue it, it may be a buyer of this business, but they're going to do it on terms that are favorable to them, the buyers, and not necessarily to current shareholders. I just go into this, if you're serious about an investment in something like a First Republic, just recognize that it's a speculation that you're making. There's no way there's no clarity, there's no way you can know the outcome. It's an investment that you're taking on the basis of hope. So be careful. It doesn't mean don't do it, but be careful.
Yeah, I'll just reiterate. We communicate this in almost all of our quarterly commentaries. This notion and concept of being an investor as opposed to a speculator, and a speculator is taking on risks and that they just really have no way to quantify. Whereas investor has a very clear understanding of what they think that business fundamentally will look like in the future. And in this environment, I reiterate Kurt's point, and they would be speculating on what First Republic will look like Monday. For all we know, just like last week, you walked in on, you left Friday, came in on Monday. It was a totally different scenario, but could be the same thing that happens on Monday for First Republic. And so that's not something that we want to do for our clients' capital. We want to protect that and grow it at a reasonable rate.
Thank you. So got a good question here that I'm sure is on the mind of a lot of people. If we have accounts at Schwab and Fidelity with balances over 250,000, do we need to adjust to be under that $250,000 level? So I'll start. And again, Walt Bettinger did address this in the interview that he did the other day, and he addressed it quite well, as you would expect. There's and what he explained is it's important to keep in mind that there's Schwab brokerage and there is Schwab bank. And so Schwab brokerage is where your security accounts are. You may have cash in those accounts. You've got securities in those accounts. You may even have money market funds in those accounts where a large portion of your cash is. Those money market funds are securities. They're not cash. And the real important point that he made is all brokerage firms, this would be true of Fidelity as well. There's something called the SEC Consumer Protection Rule. And what the SEC mandates is that brokerage firms keep client assets separate from their assets. And so your assets in securities accounts at Charles Schwab are not, they're not Schwab's assets. If something happened to Schwab, the likelihood of which is next to nothing, your accounts would transfer somewhere else. That's not a concern. But the point to be made there is that the securities are yours. Also, what we've been doing over the last, a while, and I know a lot of the Schwab financial consultants who work with clients have done as well, is, to the extent you've got money in cash, which is a bank deposit sweep at Schwab, which means they are on deposit with the bank. Over the last year, a lot of people have been moving money out of that into Schwab money market funds, which are secure, again, like I had mentioned earlier, securities. So those aren't even, it's not even about FDIC insurance there. So accounts over 250,000 is different, and it's segregated from Schwab assets. Money on the bank side, so even the bank deposit sweeps, probably most of those are below 250,000. But if you are in the bank deposit sweep at Schwab, if you have cash in there, most accounts are in what's called a multi-bank deposit sweep. So there is Schwab Bank and there is affiliated banks. And so one person with $500,000 in the bank deposit sweep at Schwab would have FDIC insurance up to $500,000 because the Schwab Bank and the affiliated bank where that is. So it really is important to look at how your accounts are structured, how much cash you have, what's in cash versus securities, and on the bank side or the brokerage side. But again, on the bank side, they 80% or below the FDIC amount, and they've got access to $280 billion of liquidity. So just don't think that there's a reason to be concerned with cash balances at Schwab. But of course, your individual situation matters, and we'd be happy to talk with you about them.
That's what I was going to add is just, reach out to your advisor here. And, this has been a conversation that we haven't had to have in a long time because yields and returned interest rates on bank deposits and money market funds have been basically nothing for a long time. And so now it's a much different scenario that we can actually get some yield on your cash assets. And so we've been actively taking advantage and positioning to take advantage of that.
A question I got, this is one that I will say before I even ask it, you'll please call your advisor at Summitry and we can talk with you about it specifically, but it's a question about Schwab stock. Is it a buy at this point, or is this a wait and see? Specific stock recommendation is something we can't talk about because there are other than clients on here. So if you're a client, give us a call. If you're not a client, give us a call and we can talk about it with you. I will say that Walt Bettinger shared in that interview that the most bought stock at Schwab last Friday in Schwab accounts was Schwab stock. He shared that in the interview that he did. So, I mean, that's not a recommendation of ours. It's not even a recommendation of his. It was just a piece of information that he shared. I think probably the same way we talked about what you might look at, although it's a different kind of business than a bank. Schwab is not a bank, but in terms of making that decision, it's about looking at the kind of fundamentals that Colin, Michael, and Kurt were talking about before. Unless I don't know, is there anything else we can add on that?
Yeah, you did a great job answering. I think you could answer it a lot simpler for those of you that clients know the answer, and I'll leave it at that.
Yeah. Okay, so there aren't actually any other questions that came in. There must be other questions. Other questions that we've received from clients. You've all asked, I mean, the ones that have been asked are very good ones. And we did schedule ourselves to be here until 1 o'clock. We don't have to be, but let's see.
Well, hopefully there'll be a few more questions, but I'll just add that we were very proactive in terms of I think we had weekly calls during COVID, during sort of that crisis, and happy, again, as Kurt outlined, as I think we've all reiterated, we don't view this as a crisis in terms of the overall system and the markets and the like, but more than happy and willing to have more frequent calls as things unfold. I mean, this has definitely been a dynamic and very interesting environment of late. So
we did get it's a ESG investment, so it wasn't really a question there, but maybe it's an opportunity though to share how we think about investing. Why not? And what we look for in investing client money.
Yeah, I guess with regards to ESG, I think we, what we're looking to do is identify, own, and invest in sustainable businesses. And what we mean by that is businesses that have management teams that are aligned with shareholders, that are aligned with their employees, that are aligned with their communities, and this kind of notion of doing well by doing good. ESG has become a bit of a lightning rod in terms of sort of people's considerations of that. At the end of the day, the best way to grow and build and compound your wealth over time is to own great businesses run by capable, great management teams that have very strong business franchises that are taking market share, that are putting their shareholders' interests first and foremost, and doing well in general. And that's just basically our philosophy in general. And so whether or not you we don't call it ESG, we call it good common sense of buying great businesses with great management teams that are looking to do well by doing good. And I didn't see the question, but I answered based on your framing of it. So.
Yeah.
Yeah, I think by virtue of what we do, it checks a lot of or most, if not all of the ESG boxes that those institutions who are tracking ESG care about, just because it's just, as Colin said, it's good common sense management of an enterprise for the long run.
Yeah, and I will add one component of our process is that we work with Morningstar has a research tool called Sustainalytics that actually assigns a sustainability rating on businesses. So we take that under consideration, but that's one of multiple criteria that we take into consideration.
Thank you guys. A question came in that said, I assume that what you've talked about with respect to Schwab's strength applies to TD Ameritrade. And yes, I mean, what I'd say is Schwab owns TD Ameritrade. So yes, we think accounts at TD Ameritrade should feel the same or have the same sense of security that you have at Schwab. A question came in.
Just so everybody knows, obviously, hopefully, you know that Schwab is in the process of integrating TD Ameritrade, which they acquired, and so the two TD Ameritrade Schwab, from our perspective, we view them as one and the same at this point.
We did get a question about, is it a good time to buy gold? So I think it's a good opportunity to talk about how we think about owning gold.
Yeah, I can start. Well, our preference is to own businesses that produce free cash flow over long periods of time. That's the source of our returns. And gold as an asset doesn't produce free cash flow. Commodities in general are assets that don't produce free cash flow. And you have to be right about the direction of the price to generate a positive return. And that's something we don't feel we have an edge in. We have an edge in analyzing businesses. We can identify it, differentiate between business that's weak in nature or strong in nature, and find the strongest businesses we can find and have an opinion about their value. But in terms of commodities, you really need to nail down the price and its direction in the short term and maybe in the long run. That's something we feel we don't have an advantage in.
I'll phrase it another way, if I can. Like I understand. I think we understand the appeal of gold is because it's a finite commodity, right? You can't make it. It's not like fiat money where the Fed can print a lot more money and debase the value. Gold is this thing in very short, kind of finite supply. But it comes down to, okay, that may be true, but what's the right price? And I think that's what Michael's talking about. How do you determine the right price for gold? It's whatever the market will pay for it. Now, we like the fact that it's limited in supply, but so it too, there's a limited supply of truly great businesses out there. And so we're looking for things that are rare too. And it's rare to find a truly great business where we can apply and attach a price that we have confidence in. So that's why we spend our time buying corporate gold, basically.
I like that. Yeah, and I was, gold has traditionally been viewed as a hedge against inflation, and kind of just reiterating Kurt's point about we'd rather own gold standard businesses that have the ability to increase their prices over time and have management teams that are able to navigate sort of the uncertainty and opportunities of an inflationary environment and grow that asset over time. And probably the most important thing is for us to be able to understand what the true intrinsic value of that business is. And I would say the same thing everybody else did. It's just nearly impossible to do that with gold, understand what the true intrinsic value of it is.
All right, thank you guys. So we got a question we got is what guarantee that Schwab doesn't commingle the bank assets and the brokerage assets? I think I would just offer again that the brokerage assets, Schwab brokerage is distinct from Schwab Bank, and it is the SEC consumer protection rule that mandates brokerage firms keep assets segregated from the firm's assets. The bank, any cash that you have in Schwab brokerage accounts that aren't in a money market fund may be in the bank deposit sweep, which means they are on deposit with Schwab Bank. That is where you've got the FDIC insurance up to $250,000, but also potentially up to $500,000 per account holder because of that multi-bank affiliated bank feature where you've got the FDIC insurance coverage through both. And again, I'll just repeat, 80% of the deposits with Schwab Bank are under the FDIC insured amount, and they've got the $280 billion of liquidity to meet client demands for deposits if they existed. So it's just it really is that is to really emphasize the point that we think your assets are secure at Schwab, your assets, securities, and your cash. And that extends to TD Ameritrade as well. Anything that you guys would add?
No.
I haven't read this. It's the New York Times and some other media outlets have recently done stories that touched on the very wealthy tech bros who stand to lose a lot of their investments, have basically perpetuated the frenzy and bullied the government into this buyout, even though everyone knows that startups are a risky investment. Okay, how do you think this government bailout of Silicon Valley Bank is going to affect the financial situation of the tech industry and also investments in the future of the tech industry?
Yeah, I think that's a relevant question that remains to be answered. For sure, Silicon Valley Bank, regardless of assessment of management and the like, they have provided a crucial funding source and facilitator, enabler of the tech ecosystem, which all of us here in the Bay Area have been either directly beneficiaries of or observers or participants in. And so I would say, and this will go back to my original comment, like this is one of the most phenomenal places in the world to live. The amount of innovation, the amount of intellectual capital, the educational system, that venture startup community that contributes to innovation and economic and growth and the like. It's very, very attractive for people to come in and supply funding. And while the Silicon Valley Bank sort of, their pool of loans and everything is sort of going through a sale process now, there's a lot of players that are interested in coming in and supporting the tech ecosystem. That's not to say that there's not a near-term vacuum and a lot of uncertainty here. But I think those of us that have been here long enough have lived through multiple tech cycles. It's been a boom and bust region. Fortunately, more boom than bust. The busts have been very short term in nature, and the booms have been decades. And so I think we have confidence that in general, the tech ecosystem that supports and allows the Bay Area to flourish will reinvent itself in some form or another in terms of the funding and the banking relationships and partners. But this is something that we're not overly concerned about. I will say that and this has caused an air pocket, if you will, in terms of funding, in terms of access to credit, and throughout the economy, not just here in the Bay Area. And so that is something that I think that we're paying attention to. Obviously, the Fed is paying attention to in terms of the rate increases that their whole mission was to slow economic growth and activity by raising rates and lowering inflation as a result of that. Remains to be seen, but I strongly believe that the Silicon Valley Bank and what's happened in the last week has really accelerated that slowdown of growth, and potentially could lead to lower rates going forward. And so would imply more access to capital eventually for that ecosystem. So
I think we touched on this, but maybe just ask it directly because a question came in, and who will pick up where Silicon Valley Bank leaves off. And I think, I mean, we talked about depositors being made whole, insured amounts and uninsured amounts. So I think maybe the question might be who becomes a funding source in the way that Silicon Valley Bank was, or a bank that Silicon Valley Bank was for the customers that were their customers. Any sense for what opportunity that creates for other could be sources of funding or banking or financing?
I don't have a sense personally of who it would be, but somebody will. This money is fungible. Somebody's going to pick up and acquire the pieces, because Silicon Valley Bank, there's a loan book there that somebody's going to buy. There's a deposit base that the buyer of those loans would likely try to assume. But there are other banks that are very active in this area beyond Silicon Valley Bank, and I'm sure they're licking their chops and wanting to pick up where Silicon Valley left off. It'll happen. I don't know exactly who.
yeah, there are probably not one single institution that will pick up most of the business. A lot of those relationships are very attractive, and several banks will fight to grab as much as they can. And we're already seeing deposits moving to the largest banks. That already happened.
And there are also non-bank players in there as well who might be interested in picking up where Silicon Valley Bank left off. Evidently, there were a couple of private equity firms that were poking around at the assets, and maybe they'll end up. I think I heard Apollo was mentioned, and one other firm, but whether they're interested in the bank loans or whether they're interested in picking up that franchise or not, I don't know, but it's attractive for some buyer.
I was on a call early this morning from BlackRock and the head of the alternatives and private credit markets, and he was saying there's about $3.6 trillion in private capital that's out there globally floating around, and so like all capital, it will eventually inevitably find its way into opportunities that they think are attractive, and so I wouldn't be surprised if we see that.
A question came in. Can you speak to the Credit Suisse financial woes, and does this relate to the Silicon Valley Bank fallout?
Yeah, I'll let Michael know, but I've been in this business. I think we all have here, 20 plus years, and almost as long as I can remember. Credit Suisse has had issues and challenges and the like, and so specifics. So I'll let Michael comment on.
Yeah, their problems are not related to Silicon Valley Bank. Credit Suisse has been in a turnaround mode almost forever. The most recent crisis has been money laundering allegations that led to their auditors highlighting weakness in internal controls. This bank has been involved in every possible scandal that broke in the world, from major losses in hedge fund trading to even scandals like hiring an agency to spy after UBS. There is a great account out there being published of all the scandals they've been involved in, and all those losses have been piling up. But most important, their customers are losing faith in the bank, and this week their backers, a bank from Saudi Arabia, threw in the towel and said that they're giving up on Credit Suisse, and that kind of forced the Swiss government to intervene and support it, because Credit Suisse is too big to fail for Switzerland. Particular, so not related to SVB, but it's a risk that's worth monitoring, and so far the regulators were very quick to respond.
So, Lisa, good question came in. Do you think more banks fail? And the second part of the question, I think, is what's the government's capacity really to help going forward? I mean, there's a number of different ways I think we could approach it. It is how many do we think more banks will fail? What are the risks of that? Well, if they do, what happens? Does the government even need to bail out? There could be a bank, say there's a bank that fails. It could be that another bank sucks it up, buys all the assets of the bank and the depositors, and so the government doesn't have to bail it out. There's a lot of different ways maybe we could answer this, but how take a shot at that? Just government's capacity, continue helping. Do we think more banks will fail?
So we can't predict if there will be more banks that will fail. I would just say that bank failure is more frequent than people are aware of. there've been bank failures in the past, but we just had a long stretch after the financial crisis with less banks failing. So maybe there is a sense of security in that regard, but banks do fail, and we have a very good process led by the FDIC of taking care of bank failures, and that's why they're not front and center and not grabbing attention. SVB was a special case, and the government theoretically has unlimited capacity to support the financial system. And I think we went through a potential failure of the financial system in 2008, and the government, with the help of the Federal Reserve, proved that they have the capacity and the tools to do it. And the tool that was used this week is just one option within a set of measures they can implement in case needed. At this point, we just don't see the fires we've seen in 08, not even close.
Yeah, okay, thank you, Michael. I think we're coming up on time here, and I'll make some final comments. And I'll answer a question that came in, and it might be that the caller came in a little bit late, but I think it kind of fits into what I want to say is to wrap up, and then I'll invite Colin, Kurt, Michael, to add anything you guys would like to add. It's just it's not clear to me from is Schwab Bank in trouble? How vulnerable are they? We don't think Schwab Bank is vulnerable at all, given their financial strength, given their access to liquidity, given that there's the Schwab Bank and Schwab Brokerage, and Schwab has been a beneficiary of this over the last week. Schwab has had a lot of net new assets, 42 billion in February, net new assets to Schwab in February. In March, month to date, $2 billion a day, $4 billion in net new assets to Schwab last Friday alone. We just don't think Schwab is vulnerable. What I wanted to say in my final comments that are wrapping up is appreciate all the questions that have come in and the interest in this Q&A session. I mean, Colin mentioned in the beginning that I've been on the front line of addressing client questions that have come in, and feel that it really is such an opportunity. We view it as such an opportunity. We understand the concerns that anybody would naturally have when something like the last week occurs. And the front lines is exactly where we're going to be, and we're going to address these questions. We're going to make sure that people understand as best we can understand what's really happening, and what are the real concerns, what are the real risks, because it's really easy to paint things with a broad brushstroke. To throw out the baby with the bathwater and all those other cliches. And our job is to be here and be available to our clients or anyone who wants to get a more balanced perspective and really kind of get a clearer sense of what's happening. So thank you for the questions and for your interest and for attending this. Colin, Michael, Kurt?
I'll just add, just thank you. And especially when this hits so close to home, people have lost their jobs. People have been concerned over their businesses and their companies. So it hits home. And so that's why we're here, is to help you navigate all of those uncertainties, and hopefully, and there always have been, there'll be opportunities that emerge out of this. So just want to thank you, and want to just greatly thank you all for the trust that you've placed in us.
Thank you, everyone. Have a great afternoon.
Everybody.
Bye-bye.